vTalkInsight, market drivers daily for March 3rd, 2026. Energy prices are jumping. Geopolitical risk is back at the center of the macro narrative, and cross-asset correlations are shifting in ways that matter for portfolio risk. Geopolitics has moved from background noise to the main macro driver, as the conflict involving Iran and its neighbors pushes oil and gas sharply higher and forces a rethink of inflation and growth paths. Compared with yesterday, when the shock was still being sized, today looks more like a sustained repricing. Brent crude is holding above $80 and has risen close to 15% since tensions escalated, while UK gas prices are around 70% above last year's average. The immediate pressure is landing hardest in Europe and the UK, where import dependence magnifies every dollar of energy price increase. European gas benchmarks have surged in recent sessions, with some contracts up more than 60 to 90% in just a couple of days. And that move is feeding straight into bond markets, where French 5 and 10-year yields are jumping by mid-single-digit percentages and UK gilts are selling off sharply. Rate markets have pivoted quickly as this energy shock collides with already sticky inflation. In the UK, traders have moved from expecting multiple Bank of England cuts to pricing in fewer than 2 moves for the year, with only a modest probability of a March cut, while UK 2-year yields are up around 15 basis points and the 10-year is back above 4.5%. In the United States, 10-year yields have reversed recent declines to trade above 4.1%, signaling reduced conviction in an imminent Federal Reserve easing cycle. Equity markets are reflecting that tension between higher discount rates and energy windfalls. European indices are under heavy pressure, with the DAX down around 4% and Italian stocks off closer to 5%, while global futures show the S&P and Dow indicated nearly 2% lower and the Nasdaq 100 down more than 2%. Energy and defense names have outperformed at times, with oil stocks up as Brent climbed 7 to 8% in a day and defense contractors rallying on expectations of higher spending. Yet even energy has struggled on some sessions as broad risk aversion dominates. Geopolitical tension is not just an oil story. It also runs through technology and currencies. Reports that Washington may cap NVIDIA's most advanced AI chip sales to Chinese buyers and potentially include some AMD products have hit semiconductor shares, with individual names down as much as 7% and reinforcing a tech-led drawdown. At the same time, the U.S. dollar has delivered its strongest 2-day gain since last summer as a classic safe haven, while the euro and other energy importers look more vulnerable, especially if gas prices stay elevated. Gold and gold miners have attracted renewed interest as a hedge on geopolitical and central bank risks, even though intraday swings show that hedges can be sold to raise cash when volatility spikes. There's a clear split in how this shock is being framed. On one side, historical analysis shows most wars since the 1970s have not caused lasting market damage unless oil stays above $100 for an extended period, and some strategists remain constructive on U.S. equities over 6 to 12 months, highlighting the country's net energy exporter status. On the other, current oil prices do not fully reflect the risk of a prolonged closure of the Strait of Hormuz, and the latest moves in European gas suggest markets are only just beginning to price a more persistent security premium. The key watch points now are the duration of shipping disruptions, any additional strikes on energy infrastructure, and how central banks talk about energy-driven inflation at upcoming meetings, which sets the stage for how supply chain stresses feed through next. The same geopolitical shock is now morphing into a full-scale logistics event, with the Strait of Hormuz at the center. Tanker traffic has largely halted as war risk insurance costs jump from roughly a quarter to over 1% of ship value per transit for some routes, and several insurers have issued cancellation notices, leaving crude and liquefied natural gas stranded at Gulf export terminals. Container lines are also affected, with flows through Hormuz effectively stopped and removing about 0.6% of global container capacity, a small percentage on paper, but enough to trigger congestion at alternative ports. Ocean freight pricing is reacting quickly to this sudden loss of capacity and route reliability. Major carriers have paused bookings or rerouted around the affected region, and some have declared existing contract negotiations void, pushing more volume onto the spot market. Reports suggest container rates from China to the U.S. East Coast may have more than doubled toward $5,000 per box, while freight on some energy and bulk routes is now running at around 14% of cargo value versus a more typical 2%. Air freight and passenger travel are under similar strain. Reroutings and airspace closures affecting hubs like Dubai and Doha have temporarily removed close to 18% of global air freight capacity, and more than 12,000 flights have been canceled, disrupting high-value supply chains and tourism flows. Airline stocks are feeling both the revenue hit from canceled routes and the cost impact of higher fuel, with some U.S. carriers already warning that a prolonged conflict with Iran could erode margins further. The regional impact of these disruptions is uneven. Asia is especially exposed on both oil and liquefied natural gas, with some estimates suggesting storage covers only a low single-digit share of winter demand, and India operating with roughly 15 days of oil inventory. If the Hormuz bottleneck persists beyond a week or two, refiners across Asia may have to cut runs, while European gas futures have already surged more than 30% on news that Qatar's largest liquefied natural gas export facility, supplying about a fifth of global volumes, has halted production. For corporates and portfolios, these supply shocks are another step away from the old just-in-time model and towards structurally higher buffers and costs. Pharmaceutical manufacturers are already shifting production and sourcing closer to the United States under new industrial policies that treat drug supply as a national security priority, while broader manufacturing and retail sectors face rising logistics and energy bills that can squeeze margins if passed through only slowly. At the same time, shipping company shares have found support from higher rates, underscoring how this disruption creates both winners and losers even as it adds to global inflation pressure. Looking ahead, the critical signals will be insurance market decisions on Gulf transits, any spillover into Red Sea routes, and how quickly container and air freight networks can stabilize, all of which will frame how the conflict itself feeds back into growth expectations. The underlying driver of these moves is the widening Middle East conflict, which has evolved into a multi-country confrontation with no clear endgame yet. Military exchanges now involve Israel, the United States, Iran, and a wider regional cast, with airstrikes, missile attacks, and drone operations hitting not just military targets, but also oil fields, refineries, and liquefied natural gas facilities in countries such as Saudi Arabia, Qatar, and the United Arab Emirates. The effective closure of the Strait of Hormuz has become both a symbol and a practical accelerator of that escalation. Domestic dynamics inside Iran and differing views among allies add another layer of uncertainty. The recent assassination of a senior clerical figure and signs of organized opposition activity point to rising internal pressure, yet security forces remain cohesive enough to suppress open dissent, making regime change neither imminent nor easily predictable. Externally, European governments, including Spain, stress multilateral, law-based responses and warn about unpredictable consequences of unilateral military action, while Gulf states like Qatar and the UAE publicly push for de-escalation even as they prepare for potential defensive moves. Markets, however, are still largely trading this as a short-duration shock rather than a structural break. Volatility has spiked, with the VIX jumping into the mid-20s and cross-asset correlations rising as investors move toward cash. Yet U.S. equities have shown episodes of resilience, with intraday rebounds leaving major indices flat or only modestly lower on some sessions. That pattern, combined with still tight credit spreads, suggests pricing is far from a full recession or multi-quarter conflict scenario. The risk case centers on duration and the mix of shipping and infrastructure damage. Analysts point out that if disruptions to Hormuz last beyond 15 to 20 days, storage tanks in Gulf states could fill, forcing them to cut production and turning today's logistics backlog into a real capacity loss. especially with Qatari liquefied natural gas already offline. Prolonged conflict beyond 4 weeks, combined with further asymmetric attacks on airports, ports, and pipelines, could push oil toward triple-digit levels, reignite inflation, and trigger a more decisive equity and credit repricing, particularly in energy-dependent regions like Europe and parts of Asia. The alternative scenario is a relatively brief flare-up, where diplomatic pressure from regional allies and major powers leads to a partial reopening of shipping lanes and stabilization of infrastructure within weeks. In that case, coordinated releases from strategic petroleum reserves and flexible supply responses from producers outside the Gulf could help unwind part of the current risk premium, leaving the episode as a sharp but temporary shock rather than a lasting drag on global growth. History shows that most conflicts have followed that pattern, with equity markets recovering once energy prices roll over. For now, the key markers to watch are any credible roadmap for the escalation, signals on whether Hormuz can reopen safely, and how central banks balance renewed inflation risk against softer growth when they next update guidance, which will determine how this geopolitical story ultimately feeds back into portfolios. The picture today is of a world where Middle East conflict is driving an energy shock, pushing inflation and rate expectations higher, and forcing sharper divergence between regions and sectors. Supply chains are under growing strain from disrupted sea and air routes, lifting freight and insurance costs, and adding another layer of volatility on top of already tight energy markets. How long the conflict and the closure of key choke points last will determine whether this remains a sharp but contained episode or evolves into a more persistent stagflationary regime. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.